So let's start learning about profitability ratios. So these are the different famous, super important profitability ratios shown here. These are the ones we'll be learning in today's video. Going ahead, there will be one slide each for each of the profitability ratio that you see here. Cool. So then let's start learning. So the first profitability ratio that we need to understand is profit after tax and profit after tax margin. Now this is very easy, right? If you have watched my profit and loss statement video, you would clearly know what profit after tax is. One new term here is profit after tax margin, PAT margin. Let's understand, right? Now, profit after tax obviously is the profit the company has generated in a year after paying all the taxes. Where can you find it? Very easy, right? You can come into the statement of consolidated profit and loss of a company, and this is again just like we did for all the last videos. We are taking example of DMart, Avenue Supermart Limited in this video also. So we have come to the P&L statement and we can easily see net profit after tax. This is PAT, right? Which is 1,492 crores. So that is your profit after tax. The next term is profit after tax margin. Profit margin. Now it is very easy. If you are someone who has some acumen for business, you clearly know what profit margin is, right? Say you did a business. When you did the business, you received 100 rupees in revenue. But in the 100 rupees of revenue that you got, after all of your expenses, what you're left is with 10 rupees of profit. Then what is your profit margin? 10 divided by 100, right? Profit divided by your revenue. So that would be 10%. It is as easy as that. So if you look here, you can see the same. PAT margin, which is profit after tax margin, is equal to profit after tax divided by total revenue. Now, where can you find total revenue of a company from? Exactly here itself, right? You can come here and you can see income. Revenue is also the income of a company, right? So total income is how much? 31,093 crores. So I've used exactly the same numbers here. See, PAT of DMart I've taken from there 1492 CR. Profit margin of DMart 1492 divided by 31,093, which is 4.79%. That is the profit after tax margin of DMart. Now this means that DMart earns a profit of 4.79% for every rupees 100 made in revenue, and 95.21% went into expense, right? So DMart owners can have that feeling, okay, when we earn 100 rupees, out of which after all the expenses, we would be left with 4.79%, which is 4.79 rupees only. Giving a lot of clarity, right? So you as a fundamental analyst, when you are learning about a company, you can look into it and you can see if a company has a profit margin of 50%, how awesome is that? Cool. So you can always do studies like that. So now one very important point here is compare profit after tax and profit after tax margin to other previous numbers and also other companies. Just like I said in the beginning, right? Always each financial ratio, it would be great if you compare it with the previous performance of the same company, and also you compare the same with other companies as well. Now, how would you do that? So one very easy way of doing that is either via using ticker tape, because ticker tape shows you all the data. But for this purpose, the tool Screener, www.screener.in, will help you even better. So here, as you can see, I've come to Screener. I've searched for Avenue Supermarts Limited. Now I am coming down. So this is the feature I'm talking about, which is peer comparison. You can take a financial ratio and just in one click, you can compare between the company that you're looking and all the peers in the industry. So I've just come into Avenue Supermarts and all its competitors are shown here. Peers are shown. Trend, we discussed in the last video, right? Trend is the retail wing of Tata, right? We could say like that. Then we have Vedant Fashions, Metro Brands, MedPlus Health, V-Mart Retail, a very, very relevant competitor, very relevant peer, I would say. So you can come to edit columns, and what is the financial ratio that we are talking about? PAT margin, right? Let's look into it. PAT margin. So that's not there. So let's type profit margin. So that is here. As you can see, NPM last year is basically net profit margin last year. So you can take that, right? So we have taken that. I'm clicking on save column and see, we can see net profit margin annually. So Avenue Supermart, we worked out how much was it? 4.79%, and on Screener it is 4.82%. So some variation will be there here and there based on what their calculation is. So some variation would be there, no worries, but it's nearly matching, right? 4.79% and 4.82%. Now you compare it with Trend. See, Trend has a NPM, profit margin of only what? 0.83%. So there you can see that Avenue Supermarts is clearly better. But if you compare with Vedant Fashions, Vedant Fashions has 30%, which is great. I would really love to compare it with V-Mart because V-Mart is a direct competitor, right? It is just 0.73%, which clearly says that Avenue Supermart enjoys better profit margin compared to its peers, and it is good for the company. So that is that. Just like that, in each financial ratio we will be discussing today, we'll be learning today, you have to actually figure out what the financial ratio is, what the number is. You have to compare that with the ratio of the same company from the previous years. You should also compare it with the peers of the company, that is other companies in the same industry. Only then you can actually judge if a company is good or not. Cool? This is clear?